Hello, everybody. Welcome to another edition of the Digital Communities Program webinar series on access to capital. For those of you who are just joined for the first time, what we usually like to start off with is if you can please enter your business and your name and location into the chat. We want to encourage participation, ask any questions you may have. This webinar series is for you. We want to make sure that we are providing content that is relevant to your situations. And yeah, so we'll give it a couple more minutes before we start. Today's session is on mastering cash flow management, and we have a great speaker today that will be able to share all this information for you. All right, Nadia, Brian, welcome. Peggy, welcome. Ignacio, Juan, good to see you. Oh, from Massachusetts, great. It's good to see where everybody's from. And again, we'll get started in a few minutes. Hector, nice to see you. Okay, so we'll go ahead and get started. Without further ado, I'd like to introduce Will. And again, this will be on mastering cash flow management.
Hey guys, how are you? I see a broker in hard money lending there, Juan Mateo. I like it. I like what I see. I'm gonna be checked today. I like it. That's always good. James, you want me to introduce myself or?
Yeah.
All right, guys. My name is Guillermo Will de Jesus. I'm the co-founder and CFO of Nagozi. I am a certified public accountant out of New York City, although I travel quite a bit because the Nagozi community, which is basically a social professional platform in Spanish, is growing. So I have to travel a lot to New York, Miami, Texas, California, and we also have a back office in Colombia. So that's kind of what I do. My past, I used to play baseball, and not professional. I'm from the Dominican Republic, so I'm required to dance merengue and play baseball. And I've done it all, but I went to college on a baseball scholarship, Queens College. And that kind of led me into finance, into accounting. I then worked for Deloitte and Touche for many years, got my CPA, started my first startup, which is still alive and kicking today, which is called taxterminal.com. We also turned it into Spanish, rapiotax.com. Then I worked as director of finance for a well-funded social platform. It went really, really well. That's kind of where I learned a lot of the startup game, so to speak, when it comes to burn and when it comes to all of these things. And then I started Nagozi with Tony Martinez over in Silicon Valley. And I've been doing this since the pandemic. So that's who I am. Thank you guys for coming. I appreciate y'all. So we're gonna get started. Yes, James?
Yes, sir.
All right. So before I get started and I start sharing some content here, what I want to do is preface everything, maybe frame it up, let you guys know at the end of the day, the most important points that I think y'all should take from this session is number one, managing cash flow, right? Cash flow management per se, which is what we're going to talk about today, is not a financial statement. A lot of people think that cash flow management is this one statement. Maybe you guys can call it an income statement. Maybe you'll call it a cash flow statement, and you've done it and it's done. It's not really. Cash flow management is a process, okay? Cash flow management is a process that entails you looking at the core financial statements, your balance sheet, your income statement, accrual and cash basis, as well as your cash flow statement, in order for you to be able to put together a process to be able to manage your cash, right? Understand your incoming cash, your outgoing cash, where you're going to be in the future. That's the tough part of managing cash, right? Because there is a financial statement that you could put together that will allow for you to document what's happening today. But when you start to talk about projections, now you're trying to tell what's going on in the future, right? And that is why this is so difficult. If managing cash was as simple as income and expenses and reporting that, this would be an easy class. But it isn't, because it involves projections so that you guys can actually let people know, either a lender or an equity partner, or maybe even an employee, where you were, where you are, and where you think you're going to be, specifically in terms of cash, right? Because you can talk about those verticals in a lot of things. You can talk about it in marketing. You can talk about it in staffing. You can talk about it in sales. Here, we're going to talk about straight up cash flow, right? I want everybody to understand the differences and to really pinpoint that there's a difference between accrual accounting and cash accounting, right? We're going to work on that a little bit today so you guys know the difference. We're also going to talk about who's this for, right? At the end of our session, we're going to talk about how we will prepare you guys a little bit better to be able to position you guys to have the best shot at getting capital, right? To have the best shot at getting capital. Everybody is not going to be a good candidate for capital. It may be a blessing in disguise if you don't get capital, to be honest with you, sometimes. But I'd like to make sure that you guys are all in a group in the best position as you can to be able to give them documents that make sense so that they can feel comfortable either saying yes or no. What I don't want banks and lenders to do is say no because the documentation is awful. That's not the right way to go about it. If your documentation is good and you got the right resources in and they say no, it's okay, right? Maybe you're not ready for capital, right? But if they say no because you put together something that they didn't even ask for, then that to me is essentially not acceptable. So let's get started, yeah? Do we have any initial questions here, James, just to get it started so that I don't miss anybody right off the bat?
No initial questions, but again, we'd like to encourage you to use the chat to ask any questions as we go along this process. We want a lot of participation. Make sure that we are covering the information that you need.
Perfect. So I'm going to go ahead and share my screen and let me know, guys, if you see
You can see it.
why cash flow matters. Are we good?
We're good.
All right. So let me just move this here. Move it up. Okay. So the first thing, why cash flow matters. First, I want everybody to understand cash flow is not the same thing as an income statement. Okay. I want you guys to know that the three most prominent financial statements in all of business is the income statement, the balance sheet, and what they call the cash flow statement. None of these are going to get you out of the process that is cash flow management. That is part of the misconception here when people say, oh, I got an income statement, I must be managing my cash. No. An income statement really is meant so that you can look at it at the end of the month, at the end of the quarter, to see how you are doing, to see what already has happened, to see where your income is coming from, where your expenses are. And then there's a thing called accruals, right? That messes everything up. That has nothing to do with cash. So please don't make the mistake of thinking that an income statement, a balance sheet, and a cash flow statement is going to get you out of cash flow management, because it is not, and you'll see why today. Proper cash flow management allows for operators to plan for growth, inventory, capital expenditures, and marketing. A plan that doesn't involve cash flow is not a very good one, right? If you're putting together a plan, a marketing plan, a hiring plan, an operating plan, part of that plan needs to talk about cash flow. It also needs to talk about income, expenses, an income statement, a projected balance sheet. All of those things are a little bit more high level. But when you're talking about cash flow, you need a projected cash flow, which means what is the cash you're expecting to come in? What is the cash you expect to come out? And where is the cash coming from? Is it going to be in the form of operating cash, right? When anybody tells you operating cash, what we're talking about is income and expenses as part of the operation. You have sales, you have expenses, maybe you lost some cash. That is your burn, right? But that's what we call operating cash. When somebody lends you money, right, that's what we call financing cash. And when somebody invests in you, that's what we call investing cash. At the end of the session, I'll show you an example of what's called the cash, excuse me, what's called a cash flow statement, and it breaks everything down that way so that you can see where your cash is coming in and going out. But by no means, right, do any of those statements give you the opportunity to say, hey, I manage my cash correctly. No, because again, it's a process. Okay, it also enables timely payments to suppliers, right? To staff, which is critical for the day-to-day. Why did I put that there? The reason I put that there is because obviously, if you have cash flow problems, the first thing you're going to do is you're going to start delaying payments. You're going to start delaying payments to your suppliers. You're going to start delaying payments to your contractors, and you start maybe even delaying payments to yourself, right? Or to your employees, God forbid. That is going to now force you into some serious cash management, because just because you delayed it doesn't mean you replaced it, right? You just delayed it. So now you really have to do some cash flow management, because the following month you're looking at twice the amount of vendors to pay, maybe twice the amount of staff to pay. Now all of that stuff starts to accrue. Now your management skills really need to hone in, right? Because you delayed things and they're not going to go away. Cool. Things to consider. Now we're talking about late payments coming from customers. Let's just stay there for a minute. When you guys have sales, or when you guys have terms, okay, if you are a company that's not exactly in a cash flow positive position, right? Let's just say a not well-funded startup, you don't have a lot of cash in the bank, then your terms should be as close to 30 as possible, guys. You guys start to give terms that are 60, 90, 120 days because you want to be Mr. Nice Guy, you may end up being Mr. Nice Guy without a business. Okay? If you have cash, then that is an asset to you. And one of those assets is going to be that you're going to be able to give favorable terms. But that may not be the case. So know who you are in the situation and understand that if you have customers and you are not heavy with cash, you really should look at your terms and try to give the terms that are most favorable to you as an entity, at least in the beginning. And then maybe when you get repeat customers, then maybe you could start thinking about something between 30 and 60 days. But once you get to terms of talking about 60, 90, 120 days, now you really, really, really better have the cash in the bank, and you really, really better be doing these exercises to calculate when you're going to get your money, because a sale today, if you give them favorable terms that are over 60 days, it's not going to come to fruition in terms of cash until another 2 months. So you got to be able to fund today. And that's what cash flow management is about. You got to keep in mind that you have to fund the business today. There are companies out there that don't have that issue, right? You got OpenAI, they probably have all the cash in the world, right? Uber, they have all the cash in the world. They were growing based on, it doesn't matter. We're going to grow and make customers as we have them. They didn't worry about having cash. Amazon, right? Growing at all costs, right? That presumes that you have all the cash in the bank that you need. Number two, high overhead costs, rent, debt, and salary. Okay, guys, always try to figure out where your dollars are going. And when I say where your dollars are going, everybody's like, oh, I know where my money's going. Right. Let's break that up. And let me give you a little piece of advice, right? I've been a CPA for 12 years. I've had a lot of clients, thank God. I have some experience. A little piece of advice when it comes to understanding where your cash is going, when it comes to lenders, and when it comes to investors, and when it comes to people that are managing and running the business, you should try to be spending money on revenue. if you're spending money to try to get revenue, that is not the same thing as spending money on what I like to call overhead, debt, salaries, and rent, right? You always want to try to spend money so that you can get revenue. That's the first step, right? Because once you start spending money and it's not on revenue, now you better be building something super valuable, right? You spend $100,000 in a month, you better have built $130,000 of value, right? Because if you're not spending any money on revenue, that means it's all burn. You're burning every month, which is okay. Some companies do that, but you really should be ascertaining how much money are you spending, what's the burn, and what is the value of what you're building, as opposed to when you do have revenue, when you do have sales, right? How much of what I'm spending, right, is giving me more revenue and more sales, right? So at the end of the day, if you can paint the picture that you are spending money in order to get revenue, and that over time you're going to get that to a profitable situation, right? That's what they want to see. They want to see that you're spending money on revenue, and they want to see what your plan is to make that money going into revenue somewhat profitable, right? Keep in mind seasonal fluctuations, obviously. For example, tax season, people that have tax practices obviously are going to make most of their money during the season, right? So what does that mean? Pair your cash flow needs to your seasonal fluctuation, right? If you're putting together a projected cash flow, which we'll talk about it at the end of this presentation. If you're putting together a projected cash flow and you have seasonal fluctuation, your projected cash flow should obviously be paired with your seasonal fluctuations. When are you spending all your money? Oh, clearly I'm going to spend all my money during tax season because that's when I have money, right? Or maybe for a restaurant that has a huge summer deck. Okay, when am I going to make all these expenditures? Oh, the best time to do it is during the summer because obviously that's when our season is in, obvious stuff, right? Forecast, accounting, and burn, right? Let's talk about accounting first. Accounting is when you're reporting the numbers that have already happened. Okay, James, I have a quick question for you. I'm gonna throw you into this, and maybe everybody can answer this, make it a little bit interactive.
Let's go.
Who makes more money, accountants or people in finance?
I'm gonna go with people in finance.
There you go. You know why? Because people in finance are projecting the future, and people who are accounting are stuck in the present.
Mm.
Something comes through the bank account, they know how to account for it, right? Something comes in, it's either income, it's an expense, it's an asset, whatever. There's amortization, there's depreciation, all great skills. I've learned all of that, right? But my bosses in all my years when I was working, they were all what, James? Finance folks,
Finance.
right? Because they know banking, they know how to project, they understand projecting cash flow, which means they're gonna understand the value of the business. And okay, let me see how I'm doing today. And then they go talk to the accountant. And then they take that and they measure up, they pair up to their forecasting because it has to make sense, right? But know the differences. A lot of you guys probably have kids. If somebody's getting into accounting, if somebody's good with numbers, if they have a personality, understand finance people usually make twice as much as accounting folks. Maybe not the same when it comes to a CPA and a finance guy, but it doesn't matter. So just keep that in mind. And it's because why? They try to tell the future, right? Which is a lot more uncertain. And the last thing to consider here is try not to mix personal and business finances, right? For two reasons. For fiscal reasons, it's not responsible, right? Because then you're going to start having to, and what I mean by that is you have your business card and you're swiping your business card all over the place. And then when you go and do your numbers, you're seeing all of these expenses come through your bank account. Now you're gonna have to make adjustments to them and mess around. You know, you're better off paying yourself the salary and then taking from the salary for your personal expenses, because then there's just gonna be too many adjustments. The second thing that's gonna be hurtful for you when you mix your personal with business is that there's a thing in legal called breaking the corporate veil, right? A lot of people say, oh, I want to be an LLC. Oh, I want to be a corporation. Oh, I want to be an S corp. Why? Because I don't want to get sued. If I get sued, I want them to sue the corporation. Ah, great. But you just paid for your vacation with your business account. You just bought a bunch of gifts with your business account. In a court of law, they may see that as breaking the corporate veil. Now you're opening yourself up to regular lawsuits, and everything you did in order to not have that, right, is now there, right? So it's not, now you've just opened yourself up to risk. So not only does it mess up your financials, it also increases your risk. So try not to mix business with pleasure, right? Is this a good point to just stop for a second, see if there's any questions, James, you think, or should we just move forward?
Yeah, if anybody has any questions, again, please put them in the chat, or we'll repeat them over here. Um,
Cool.
all
Good.
right,
Sounds like,
everybody's
thank you.
good.
Thank you, Caesar. I appreciate you.
Good sellers.
All right. Let's go here to move this chat out of the way. Sorry. Okay, key principles of cash flow management. Remember, before anything, before any of these here, remember, cash flow management is a process. It is not a financial statement. There's a ton of financial statements out there that are going to allow for you to achieve proper cash flow management. But it's not just one. It's not just the income statement. It's not just the cash flow statement. It's not just the balance sheet. It's not your projected cash flow. Although somebody may argue that your projected cash flow statement may be the one that's most helpful. Yes, but you still have to make it a process, right? To understand, am I paying my bills? Am I paying them late? What is my burn? What's coming down the pipe? All of that has to be constantly on your radar, and you have to look at it as needed, right? Don't obsess over it, but you have to look at it as needed because, again, your operation, which I like to call marketing, sales, and product, it all fails if you don't have any cash. So track inflows and outflows consistently. We're going to give you a template so that you guys can understand that. And maybe make your own template or maybe look at a software that's out there. I'm going to make a couple of recommendations before the end of this session. Forecast your cash flow 3 to 12 months ahead. That's minimum, right? That's minimum. You're going to have some people that are going to ask for 3, 4, 5 years ahead, especially in the startup game, right? Generally, a bank that's going to give you a small to mid-sized loan, you may have 3 or 12 months. And that's all you need. But generally speaking, you want to be out 3, 4, 5 years at least, right? Because there's a thing called the cash flow, the projection model, right? It's a little bit advanced, but the model is just exactly that. It's just a model. This is what I think my income is going to look like. This is what I think my cost of goods sold are going to look like in terms of a percentage, right? 15%, 20%, 30%. This is what I think my operating company income is going to look like, right? And then this is what I think my SG&A is going to look like, my sales general administrative cost is going to look like, and this is what I think my profit is going to look like, right? And this is what I think is going to happen over time. That's what a model is, okay? It's just a financial cash flow model so that you are like, okay, this best case scenario, this is what I think is going to happen. And now you have to constantly look at it to match, map, and adjust the model, right? We talked about this before, separate your business and personal accounts. Understand your cash burn. Okay, so I have an example here, and I hope that it's going to make this as simple as it really is, okay? Because it is simple. So the first thing I mentioned was operating cash, right? Operating cash is the amount of money that you're bringing in from sales, spending on the operation, and then the net, whether it's positive cash flow or negative cash flow. That's what people are asking about when they're talking about operating cash, right? It starts to get a little bit freaky when you start to bring in debt and you start to bring in equity, right? But that's equity, right? Is investing, and debt, right? That is lending, right? Those are different forms of cash. So if a startup has $100,000 in the bank, let's just say the startup has $100,000 in the bank, right? To all of you guys that are going to ask the question, it doesn't matter where it came from once it's in the bank. It could be financing, it could be investing, or it could be operating cash, right? Let me repeat that again. Those are the three forms of cash: operating, investing, okay, and financing. Okay, financing is obviously debt, investing is equity, and operating is your sales minus your expenses equals your net cash flow, right? Cool. If a startup has 100, move this up, excuse me a second. If a startup has 100,000 in the bank and spends $25,000 more than it earns each month, right? We're talking cash here. We're not talking accruals, right? We're not talking when you make a sale and they haven't paid you. And we're not talking when you've incurred a service and you haven't paid it. Very important in cash flow. It is not accrual at all. This is essentially, it works as if it's an inventory of cash, right? Let's go back. If a startup has $100,000 in the bank and it spends $25,000 more than it earns each month, right? Not including depreciation, not including accruals, the cash burn is going to be $25,000 a month, right? What does that mean? That means that it's going to have 4 months of runway. That's another term that you're going to want to have. You want to know your burn. What's your burn in this example? $25,000 a month. What's your runway? Well, if I have $100,000 in the bank, right, and I'm burning $25,000 a month, my runway is 4 months. Let's go over that again one more time. You have 100 grand in the bank, you spend $25,000 more than what you made, right? That means you spent, right? That means however it happened, let's say you brought in 100,000 in cash, but you spent 125,000, right? Let's say you brought in 200,000 in sales, but you spent 225,000. Look what we're looking at here, right? You brought in 200,000 in sales, you're projected to do $2.4 million in sales, but you're also projecting to lose right around $25,000 a month in cash, which means in a year, you're talking about $250,000. In some of the startups that I've seen, 2 million in sales, $250,000 in burn, you could explain that as long as you continue to grow the asset, right? And understand why is it that I keep burning, and in a situation where I'm not growing as fast, can I stop the burn, right? Because think about it, guys, James and everyone, the burn is there because you're growing that fast. It should be. If you've got a burn and you're growing at a regular clip, you better figure out that you're not going to have to figure out where the efficiencies are. And you may have to cut, they call it cut into bone, right? But if you are burning cash, and that's because you're growing so fast that you're throwing a lot of money into marketing, and that marketing is getting you a bunch of customers, and those customers are repeat buyers, that is actually not a bad story, right? Don't think of it like a mom and pop business unless you have a mom and pop business. When you're burning, it all depends on where you're spending your money. If you're burning because you're marketing and you're gaining market share, you could explain that. But if you're growing at a regular clip, you're not getting any market share, and all you're doing is operating, burning, operating, burning, operating, burning, and you have no idea, it's getting worse, it's not getting better, and you have no idea why, and you're not growing at a fast clip, and you're not gaining customers and market share, that's when you're going to have some explaining to. Okay. Practical strategies. Invoice quickly and offer easy payment options. Okay, I'll give you a couple of tips in my last 10 years. 2. 1, the first one is obviously there's a lot of technology out there like Xero, like Square, like QuickBooks, like FreshBooks, where you are able to invoice people super quickly via a link from your phone and it takes them 6 clicks to pay. Right? I've done it before. So that's what I mean by invoice quickly. Now, that's one. The second piece of advice is better than the first one, right? When you talk about terms, if at all possible, and you're talking about terms that are gonna be you're not just selling a product one time, right? You're selling, let's say you're selling a service. Try to get out of even invoicing, period. You could do it two ways. One, you could send them what's called either a Stripe link, right? Or a WooCommerce link. And that's going to be a reoccurring thing. Did you make a 3-month plan? Did you make a 6-month plan? Did you make a 9-month plan? What did you do? Doesn't matter. The card is in, it's gonna do it automatically. Okay. And the other way to do it is through QuickBooks and through other companies. You could actually do you can actually get authorized to do an ACH, automatic ACH at the end of the month. I was not, as an accountant, going to send an invoice and pray that they pay me in 10, 20, 30 days. I just wasn't going to do it. So I led with, listen, my fees are a lot more competitive than the next guy or gal. But the reason they're that way is because I'm either going to send you a Stripe link, so it's going to bill you recurrently, or I need to take an ACH out of your account. It went really well for me, guys. 99% of the time, when you have somebody that says no to that, they're going to be the ones that don't pay you. Right? James, if you're okay with paying me, are you going to tell me no if I tell you, look, put the card through, it's a 3-month deal, and if anything happens and I don't deliver, you stop it? Are you going to have a problem with that? No. But if you don't want to pay me, or if you bad thoughts in mind, you're going to say, no, please send me an invoice. And you're going to pay that invoice. And some companies, some models, some services are able to sustain that. And others will not. And if you have 3, 4, 5, 10 of those, you're going to have a significant problem. And it's going to be a sad problem because you probably have a quality product, right? You probably have good sales. You probably have good marketing. But now what you have is a collection issue, right? Okay. Encourage early payments with discounts. I've always done that, right? Listen, if you pay me every month on the 1st, I'll give you a 5% discount, something like that. Negotiate longer terms with suppliers, right? Now let's turn the tables. You are the one that's going to end up having to pay, right? Now you're going to want to talk to them and say, okay, let's talk about terms. Can you extend me 30 days? Right? They may have a model where it's sustainable. They may not. It's okay, but it's always good to ask, right? Use technology, right? Softwares and dashboards like QuickBooks, Xero, and other cash flow tools, not just billing and payment tools, right? There are tools out there that allow you to easily bill. There are tools out there that allow you easily to collect, but you also need a financial management system that's going to allow for you to create financial statements. Take these notes, please. Financial statements. It's going to allow for you to do a small forecast, and that's going to allow for you to be able to manage that on a regular basis so that you have an income statement, you have a balance sheet, you have a cash flow statement, and you have somewhat of a forecast. Those are the 4 things, right? Those are the 4 things that you guys always want to have at the minimum. Income statement, balance sheet, cash flow statement, okay? And some type of a forecast. And I'll show you the basic ones at the end of this, right around the 50th minute mark. All right. Where are we here? Tools to help. I'll talk about these again. QuickBooks, Xero, FreshBooks. We have some forecasting tools, guys. Some forecasting tools that work. Float is one. Pulse is another one. Parallel is the one that I use. That's actually a startup out of California as well. And they actually help you as well implement, which is important, right? Because some of these things are not that easy to do, especially if you're not a financial professional. PayPal, Stripe, Square and QBO. We talked about QuickBooks already. Budgeting and expense tracking apps, kind of like these right here, the Float, right? So this is kind of your tech stack when it comes to financial management. But at the end of the day, where you want to get is an income statement, a balance sheet, a cash flow statement, and somewhat of a budgeting forecast. That way you know where everything's going. All right. We're good on time. Yes. Monitoring and reviewing. I get this question a lot. Will, how often do you have to look at this? Well, it depends on how much resources you have, right? If you're a solo founder, solopreneur, or maybe you have a very small team, I'm of the premise and of the opinion that the most important thing is marketing, sales, and product, right? You try not to put or anything else in front of your marketing, your sales, and your product. But then right after that comes cash flow and financial management, right there. And if you find that it's taking too much time, and you have to figure out the amount of time that you're comfortable. I like to look at things on a weekly basis. I don't look at things on a daily basis. And then worst come to worst, I look at things on a monthly basis. But when it comes to cash, I'm looking at my cash more than once a week. Because I want to make sure that nothing funky is happening and that my expectations are correct. Right? So a very, very good and simple habit is to look at your finances once a week. And when I say look at your finances, look at your bank statement and look at your cash projection. What did you think you were going to spend that on? Right? That will allow for you to see silly things that are going through your bank account that are not supposed to. Because let me tell you, people are very aggressive these days. James, I'm from the old school. I was born in the 70s. I've never seen so much nonsense that because all of these tools are out there and they're hacking and the PayPal and this, that, the other thing. And sometimes they go through with $2, $10, $12, a subscription that was supposed to expire years ago, a hotel that puts through $100 and doesn't give you the credit back because they put through, how when you go into a hotel and they have to do $100 on incidentals? Oh, but I didn't make any calls and I certainly didn't go to the little snack bar. Where's my $100? Right? And it doesn't come back. You have to look at your bank statement these days because there's all sorts of craziness going on now, right? And I look at it every week. I look at my cash projections every week, and I map that to my bank statement. So what does that mean? If I expected to spend $100,000 in a month, and I look at my bank statement in a week, and I'm already at 60 grand, what happened there? Is there a timing thing there? Is there 20 grand that's not going to come around the next month, the next week? Like, did something happen? That is a very, very, very good habit, right? Half an hour, 1 hour, bank statement, cash flow projections. What happened this week, right? Try to get into that habit. If you can't do it every week, okay, then maybe you could do it. Maybe if you missed a week, you go to the following week. But sometimes you do get hurt when you do it monthly. That's my point here. Because sometimes it's too late. And then you panic. And when you start to panic, then you have all sorts of problems. All right. Strategies. Where are your dollars going? We talked about this in the beginning of this presentation, right? Is it going to cost of goods sold? Is it going to SG&A, which is selling, general, and administrative costs? Is it going to something else other than cost of goods sold and SG&A, right? Because you could look at things like, I just looked at my bank statement today, James. And when I'm abroad, for lack of a better word, they hit me on the head with those transaction fees. So I got to be careful, right? And then debt, right? So how much is going to cost of goods sold? How much is going to SG&A? How much is going to other costs? And how much is going to debt? Right? That's kind of what where your verticals are and where you should be thinking about. And again, you always want to see if at all possible, if you have sales, that a majority of your resources are going to sales, which means it'll be here to cost of goods sold and obviously to SG&A. Okay, some key takeaways here. I have a couple of slides left. Cash flow management is a process, not a statement. Okay, generally speaking, your statements are going to look like income statements, balance sheets, cash flow statements, and projected budgets. But it's not just one thing, right? It's a process, not a statement. For loans, okay, so let's talk a little bit about preparing you guys for funding, right? For your loan and what a banker is likely to ask for, or maybe an underwriter is likely to ask for, right? Generally speaking, what they're going to want to see, they're going to ask for your bank statement, right? Because that's supporting documentation to the statements that they're going to ask for and receive, right? So generally speaking, they will probably ask for bank statements. The next thing that they're probably going to ask for is an income statement, right? And if I were, and for the purposes of a loan, I would give them both an accrual one and a cash basis. This way they can see what your cash is looking like at the end of each of a good month and what it looks like in terms of what's the difference between the cash and accrual, right? So you're going to give them essentially the income, expenses, and the balance, and the either the positive cash flow, negative cash flow from that on a monthly basis. Now, here's where it gets to a point where you need to make adjustments, right? There's a thing called, you're going to look at your income and you're going to try to make adjustments. Those adjustments can go up and down, right? What does an income adjustment look like? Number one, you're going to look at and say, wait a minute, I know that I have a customer that constantly pays me, and this is real world stuff, constantly pays me through Zelle, and that always goes to my personal bank. That happens, right? You move fast, maybe it's early days for you, whatever. Don't lose that income. You should make an adjustment and say, hey, I also make $14,000 a month, but this particular client pays me through Zelle, and let me show you my personal, and let me show you the contract I have with them. I'm trying to get them to pay me to my bank account, to my business bank account, but it hasn't happened yet. Don't lose those sales on account of that technicality, right? So make sure you adjust for sales. The other piece of it is sometimes you have to adjust down for sales, right? What does that mean? People that are not going to pay you a percentage for that, maybe, and possibly sales that maybe they're friends, family, that kind of thing, where it's not really a recurring sale, it wasn't a real sale, it's not going to continue on. You may want to adjust down for that. So you adjust up for sales that didn't go through your bank account for whatever reason, and you can explain it, and you adjust down for sales that probably not real sales. It's not going to be recurring. I don't want to mislead people. Up or down adjustments. Okay, expenses. Same situation, right? You're going to want to make adjustments, but I'm going to double down on one type of adjustment called an add back. Obviously, expenses. If there are other expenses running through other accounts for whatever reason, you're going to want to make that adjustment. It's not going to help you, but you got to be fair. You can't be misleading. You can't give a bank information just to get the loan, and then in reality, all of the expenses were being run out of a different bank account. That's not cool. You can get into a lot of trouble with that. So make sure that your expenses are there, and if you have expenses running through somewhere else, you should make that adjustment. But on the flip side as well, when you have costs that are not necessarily in line with the normal operating costs of the business, that's called an add back. Okay, I'm going to put it here on the add backs are real. What is an add back? I have a company James is my brother. I hire my brother James from time to time, but it's a favor. He's not really helping me out. It's a family thing, right? He's not going to be regularly working with me, right? I gave him something in the summer. I gave him something for 1 month. All of that, that's an add back. You could always say, hey, the 1,500 bucks that I spent on James in January, I'm adding that back. That's not a real expense. What does that mean? That goes down to your positive cash flow. If you can explain it right, you got to be able to say, hey, I added back X dollars, and here is the explanation, and here is the support. If the support and the explanation is up to par, you can be okay. I'll give you another one. Kids, people that hire their kids, right? For other reasons that aren't really for the business. Okay, another one. Salaries. Let's say I'm the owner and I pay myself $250,000 a year. But if I was to hire somebody on the outside market, they would only cost $100,000, right? You can go in there and explain, hey, I want to sell this business, or I'm looking to get a loan. And when I get the loan, things are going to change here. I'm not going to run this business. I'm going to hire somebody to replace me. So the 200,000 that's coming to me, that shouldn't be there. I'm going to add back 100 grand, which means I'm going to take 200, I'm going to make it 100. What just happened? I just dropped $100,000 to my bottom line, right? Always keep add backs in mind when you're talking about selling your business or when you're talking about getting it financed. What are the adjustments that you can make and be able to explain that will make your cash flow look more realistic? And it goes both ways, guys, right? Increasing, decreasing sales, increasing, decreasing your expenses. Okay. Next here, let me do this here. Final thoughts and bonus narrative on preparing for a loan. An operation consists of marketing, product, and sales. And before that, it's cash management, right? Because you can't fund your marketing, your product, and your sales unless you have cash, right? When preparing for a loan, and I should say when preparing for a loan or for an acquisition, right? I am not of the premise that people should try to do this yourself. You want to do something yourself, lay down a floor, you know what I mean? Tint your windows on your car, you know. I'm not sure you want to do your own taxes, and I'm not sure you want to prepare yourself for an exit or a loan if you're not a financial professional. You could spend the time doing that, but understand it's going to be a long learning curve, right? And understand you've got an operation that's going to be in the background too. So I don't think it's the best use of your time. The best use of your time is to find somebody that's going to learn about your business. They're going to give you good suggestions. They're going to put things together for you in the right way that benefits the business. That's my opinion. Only provide what is asked for. Okay. If they only ask for a cash-based income statement, only give them that. If they only ask for an accrual cash, income statement, a balance sheet, only give them that, right? They're not in the business of reviewing things that they didn't ask for. Okay. And the last thing here is, like we talked about, make adjustments to your income statement, especially in the form of expense add backs, right? Always look at your expenses and say, wait a minute. After I get this loan or after I sell this business, these expenses are no longer going to apply, right? You're not going to be able to just say it. You're going to have to support it. But it's a very good thought process, right? And I want to go through, unless we have questions now, I can take questions now, and then we can go through some of the templates that I have, James, or we do the templates first. What do you think?
Yeah, let's pause here just to see if anybody has any questions, and then we can go into the templates. Just for me, just hearing you speak, and we need to implement a lot of things that you've talked about. I'm gonna talk to Robert, but yeah, a lot of valuable information here. And again, this is being recorded, so we'll have it up back online. So for anybody who wants to review it, or feels like they need a little refresher on a lot of the tips and tricks that Will has provided, it will be up. We will send everybody an email on that, along with a link for any consultations that you may need. Will help steer you in the right direction. But with that, let's go into your templates to see what that looks like.
All right, so let me go ahead and share this here. This is, can you guys see?
Yes, we can see.
So super simple, right? This is used to calculate your burn. Okay. Well, this is more, sorry, not for you, not for your burn. This is the first one. This is cash flow management, right? So look what we have here. First of all, that you want to see, we're doing it on a monthly basis, right? That doesn't mean that we're not looking on it at a regular basis. Remember, guys, what you're looking right here is a financial statement, right? But I told you, cash flow is not a financial statement. Cash flow is a process. So you should be looking at this on a weekly basis and using this to be able to document what actually happened, right? But you got to look at it on a weekly basis. All right, so you're going to take your sales revenue, your loans, your investment, and any other income. We're talking about income that has already hit the bank because we're talking about cash, right? And then you're talking about your cash flows, your outflows, your rent, your salaries, and everything else that goes out. And in here, you're going to put the opening balance of your cash and then your closing balance of your cash. This is a running thing, guys. It runs, right? It always runs from the last month. The last month's ending balance becomes the next month's beginning balance. And you have expense, then you have activity. Then you have another ending balance, and that ending balance becomes beginning balance. Then you have activity. You can go on forever if you do this and you actually dedicate the time to do this, and you can see, and it's very valuable to see where and what has happened over time. Very important. Okay, so this is, I'm sure James is going to be able to get this to you guys. Super simple, right? The next is just look at this little cash burn exercise, right? Cash burn exercise. In this exercise, our opening balance, James, is $50,000. $50,000, right? Then you have cash inflows of that, cash outflows of that. So what do you have? You brought in 10, but you spent 15, right? You brought in 10, but you spent 15. What does that leave? That leaves you a net negative cash flow of 5, which means your cumulative balance of cash is what? 45, right? Then 45 starts again. Okay, here we go. February, 8, but you spent 16, you're down, now you got even worse, 8, you're down to 37. Okay, then you got in 12 and you spent 15, you did a little bit better. Now you're down here. You see what's happening here. Now, more important than anything is this right here. What this is telling you is that your average burn here is $6,083. Okay, $6,083 means that your cash runway when you started with 50 in the bank is 8.2 months, right? Because 50 divided by the 6,000 is right around 8. So if you start with 50 and you average, so here's the premise of the whole exercise. If you start with 50 grand and you average $6,000 of burn, okay, then your cash runway is 8 months.
Well, real quick, we had a quick question in the chat. Is where is the 50,000 on the sheet? Where would you fill that in terms of?
Usually, what I like to do is you would put it up here. If you do this and you insert it, you start here.
Okay, so you can just see it from.
Yeah. And this is January 1st. Okay.
Thank you.
So January 1st, you started with 50,000, right? In January, you brought in 10,000, you spent 15, right? You have $5,000 in burn in negative cash flow. You're down to 45, right? So you burned $5,000. If someone was to ask you right then, right there, what's your cash burn? You would not say 8. You would say 10, James.
Hmm.
You don't know if it's gonna go up or down. So let's say this was your first month of business. You start with 50 grand. You got 10 in, 50 out. I spent 5 grand. I lost 5,000. I burned $5,000 in cash. If it continues to be this way, I only have 10 months. Right? But then the next month, right? You're at 8 and you spend 16. Now you're at 8,000. You can't say you have 10 months now because it's not 5 grand. Now it's 8. Now you have to average that out and say, okay, let's just say, you're going to give yourself the benefit of the doubt, right? Because look, you have 37,000, you spend 8. That's a little bit more than 4 months, but that's not your average.
Hmm.
Your average becomes 6,000, which means at the end of the day, your cash runway would be 8.2, right? How much cash do you have today? What's your average cash burn? That becomes your runway, right? And then this is an example of another thing. Remember, we talked about 4 things. You should have an income statement, QuickBooks. You should have a balance sheet, QuickBooks or Xero, right? These are all financial systems that work. NetSuite, there's a bunch of them. That's what you need a financial system for, right? In the income statement, you know, balance sheet, and the financial system also is going to put together a cash. We're going to go over it. It's going to put together a cash flow statement for you, which is nice, but that's not enough. That's not enough. What you need is this, right? And generally speaking, the system and the financial statements will help you do this. Like QuickBooks, this is actually derived from QuickBooks because it has a cash forecasting module that allows for you to do this, right? But it's not spitting it out for you. This is what I'm telling you. You have to go in and you have to actually make it a process to be like, okay, I projected, this is how I do it, right? Last month's income statement, I roll it. It shows up on QuickBooks. And then I start to project the following month based on last month's. Right? And then I try to get in the things that I know are going to happen this month, next month, and the month after that. This way, I at least have real numbers on the left side, projected numbers here, and then I would have a variance going forward. Okay? So that's kind of what this looks like. In this situation, I did a really bad job. So James, you know, what happened here? What was the main problem here? Why my projections were so off to the point where I ended up losing $11,000 rather than gaining $1,000. What do you think happened? I'll help you. My actual sales were 8,000. I budgeted 17,500 for you every time. Right? So $9,272 of the $11,928 burn was the fact that I didn't get sales in. And that's gonna happen, guys. Sales it doesn't grow on trees. That's not how it works. But you gotta try and be as close to it as possible, right? And consistent.
And that was based off the previous month?
Correct. I always, with financial statements, right? And then what I do is I can do a projected accrual income statement and a projected cash income statement. See, it starts now you can see why this is gonna take a little bit of time. Because you're gonna need both, right? You're gonna need the accrual one because you're gonna want to know where your income and your expenses are gonna be on your financial statements. That's what everybody's going on. But you're gonna want to do a cash basis one because you're gonna want to understand where your cash is going. Right? So, but it all starts to me with your actuals of 1 month. You bring it over to the next month, and then you budget from there. That's how I do it. People may do it differently, who knows? This is what an income statement looks like, guys. Right? You have your income. You classify your income accordingly. Looks like I have some uncategorized stuff there, which means I have to go in and figure out what happened there. But at least we put it as uncategorized so that we know that we have to go categorize it, right? Then you have your cost of goods sold. This is called your gross profit. Then you have this here is called your SG&A, right? And then you have your net profit, your net operating income, And then after that, I like to add, this is a preference, sometimes people put it inside. I like to add my depreciation, my taxes, my amortization, and my interest. That way I can come up with EBITDA. I like to do it after, right? It takes a little bit of work because I have to readjust and take things out and put it back because QuickBooks doesn't do it like that. But there are some systems that you can configure to do it that way, where anytime you're going to take interest, taxes, depreciation, amortization, it'll back it out. This is what a balance sheet looks like. I know I'm over, guys. Sorry. This is what your balance sheet is going to look like, right? Which is basically all of your assets here and your liabilities here. I'll give you one little tip. You see this right here? Because I'm building America's first social professional platform, I'm spending a lot of money in tech. And I want to give myself that as an asset, right? That is very not controversial, but there's a lot of accounting pronouncements on that. You have to be able to do it right. Generally speaking, some research and development are going to be costs, but some others are able to be capitalized. If you don't know that exercise, you should find a professional to do that for you because you're cutting yourself short by just making it an expense and not capitalizing it. Okay. And I think there's one more. Oops, what do we have? Your cash flow statement, right? And this is again, this is not a forecast of cash. This is where all your cash went. It already happened. You can't do anything about it. That's why you have to manage your cash on a regular basis and not think that a cash flow statement is going to do the job. Because once you start doing your cash flow statement, James, all that stuff already happened.
Yeah.
It's good because you want to know what happened, but it's not good in terms of being proactive. So this is what a cash flow statement is going to look like: operating activities, investing activities, like somebody investing in you, and financing activities, somebody giving you a loan. That's what I have for you guys today.
All right.
Open it up to any questions, and I'll give you guys my email in case you have any
Yes,
other.
please.
If I can help you in any way, I'm happy to do it.
Rosina, I think you had a question. If you're still there, if you want to be able to ask that in the chat, or if you want to get on camera, we can also do it that way.
Okay, Rosina. Well, Belinda has one, and Rosina. Let's go with Rosina first. Is it true that banks have to lend to new small businesses? Well, they're not required to do anything, but there are programs out there that they are required to abide by the guidelines of some of these SBA loans and some of these other impact loans that are out there. So, and so, it's a little bit complicated. Sometimes they're lending their money, sometimes they're administering somebody else's program, right? So what you want to look for is really like an impact fund that gives small businesses, Black and brown businesses, impact businesses the benefit of the doubt, right? And there are a few of those. I can send you guys those. Short, not now, but maybe I can email them, James. But what you really, what business and you're an impact business is an impact program, right? So TMC Capital is one of them. Okay, TMC Capital is one of them, Rosina. And the other thing you want to look for is you actually want to look for there are private equity firms that only deal with this, right? So look for impact private equity firms as well. Let me help. Thank you, anonymous attendee. I appreciate it. I hear, this is from Belinda. I hear you about not commingling, but are there any exceptions to the rule? Example, I may pay my rent, which I'm a home-based operation directly from my business account. I recently started doing that. Do you suggest that I transfer my business account to my personal account to pay my rent and other expenses, phone? So the way it works on the tax side of things is you're actually supposed to do an allocation so that you can write it off, Belinda, right? So if you use 60% of your home, 50% of your home, 40% of your home for personal use, and 60% of your home, 50% or 40% for business use, then you're only supposed to put that through. So that being said, 3 ways to do it. you put it all through the business and then you make an adjustment. You put what you're supposed to through the business, and that way you don't have to make an adjustment, and that way your tax guy knows exactly what to put on the tax return. Or you put it all through your personal, and then you pay yourself out of the business to reimburse yourself for that portion. One of three ways to do it, but none of them are necessarily wrong if you make the right adjustment.
Yeah, we'll be sending out an email with all this information along with Will's information, some links to some consultations, the screen recording. And yeah, we'll have that information for you shortly after this presentation. We'll be sending out a mass email to everybody so you can have all of that.
I'm gonna put here in the notes one of them is a bank and one of them is a venture capital fund that is a impact fund as well. TMC Capital, they do a lot of loans. They're in the West Coast. And the ICA fund out of Oakland, they are also very much an impact fund. So you could start there, but you could also Google your way through impact funds and those kinds of lending and equity institutions so that you can see what it is that they need and then prepare accordingly and give yourself the benefit of the doubt. Thank you, Ray. I think we're good, James, yeah?
Yeah. All right. I'd like to thank everybody for joining us. I'd thank Will, especially. I know that I'm going to be working on that process again, a process. Once you start getting used to that habit, it'll start coming to you. Use those tools that he recommended as well. And yeah, I'd like to thank everybody. And Will again, thank you so much.
Contact there, James. Sorry.
Sure.
Oh, one last thing. Sorry. I forgot to mention. How can I forget to mention? I don't know if anybody, we're going to be in San Diego for the Avance event. And you guys, if you're going to be in town and you want to be around the best and probably the most Hispanic professionals out there, this used to be the Latitude Conference, and now it's the Avance Conference. It's the National Association of Hispanic Realtors, a bunch of other organizations, and Negozi is going to be there with 500 of their tax pros. We're going to have over 4,000 people here,
Right.
a bunch of speakers. If you guys want a discount, I can just send me an email and I'll put it together. You can attend the event virtually, or you could attend it live, and it's for 3 days, Thursday, Friday, Saturday, September 18th and 19th. So I don't think if you guys can make it, you guys should try to make it. The reason I say that is because it's gonna be the best real estate people there, the best tax people there, and the best capital people there. So if you're looking to really understand this a little bit more and looking to make connections with people that can possibly give you a business loan, this is where you want to go. This is where you want to be. So shameless plug, I will be speaking there too.
That's great.
All right.
Thank you again, Will. But yeah, look out for that email from us. We'll have all this information along with the link to all these assets. And yeah, thank you everybody for joining.
Thank you. Appreciate you guys. Have a wonderful rest of the week. Take care. Thank you for having me, guys.
Thank you.